Welcome back to Money, Money, Money. On our mind this week is the relevance of tax-free bonds. While they still have a place in the debt portfolio, opinion is divided on whether they are all that and more. GAURAV MASHRUWALA has been answering our many questions, and it's now time to increase the scope of our discussion. Given the state of the market, it's only pertinent to bring up the larger topic of a debt portfolio. But before we do that, here's a quick look at how debt funds actually work.
The prices of fixed income securities are governed by the interest rates prevailing in the market. Interest rates and prices of fixed income securities are inversely proportional. For example, consider a 10-year government bond which has a face value of 1,000 rupees and a coupon rate of 8%. This means the holder of that bond receives an interest payment of 80 rupees. If the interest rates are cut to 7%, this means that the existing bonds at 8% coupon will attract more buyers. So why does this matter to you? Well, governments and businesses raise capital by accessing the fixed income markets. The bonds which are therefore issued are bought by mutual funds, and a subscriber to a debt mutual fund invests indirectly in them. The NAV of such debt funds vary with the prices of bonds they hold and the interest being accrued on them. Since the prices of the bonds are governed by interest rates, a change in the interest rate is reflected in the NAV of the debt fund. The NAVs of the debt mutual funds hold the same inverse relation with interest rates. This means if the interest rates go up, then the NAVs of the debt funds go down. And conversely, if the interest rates go down, the NAVs will increase.
So Gaurav, let me start with the basics. 2015 was supposed to be a good year for fixed income. 2016, as you're looking at the outlook, is there going to be an encore, or is this a year of more measured expectations from the fixed income market?
So I wish I knew, and then I'd be the richest person on planet Earth. But usually we have seen inverse relationship between equity and debt. So whenever the equity markets are not doing well, the debt instruments will give you better returns, and vice versa. To that extent, construct a portfolio based on your requirement, which is what as a financial planner, most of the planners would be saying. For money which is required after 7 to 9 years, pick up equity, which is required next 2 to 3 years, pick up debt instrument. And then there are various options within debt instruments. It could be a tax-free bond or a debt mutual fund or PPF or bank FD or whatever. But don't look at the external conditions and construct your portfolio, because your requirements are not as volatile. So if my daughter has to go for higher education in 6 months' time, I need money after 6 months. I can't tell her, let the interest rates fall and then you go for higher education. So, I mean,
or let the equity market pick up and only then you can join college.
Exactly, right? So my condition is not based on external situation. To that extent, while it's great to discuss and, keep an eye on what's happening, end of the day, construct a portfolio based on your requirements, on what will happen in 2016, while we all feel rate of interest will fall or remain here. Focus on your goals.
Yeah, that's true actually. But tell me one thing now, within the fixed income space, how are duration vis-a-vis accrual funds? I mean, is there a shift that we're seeing from duration to accrual?
So here, for somebody whose profile is more for accrual, because the person is putting in money in debt funds, saying that I want surety of return or certainty of return, has to go for accrual, because what they are saying is these funds will invest and more or less hold on to those underlying papers, those bonds, debentures, government security till maturity, and hence the return will converge with the yield. Somebody who's saying I want to take a call on interest rates, or I'm bullish or whatever, which usually is not a very good profile, because if you are looking at that, then go to equity market. But here, since we are talking that, then you pick up duration and then you go for a long duration fund, because they'll be more volatile, or we have just dynamic bond funds which will be kind of shuffling and all. So take that call, but then be ready for the movement and a higher, what we call standard deviation sigma, but let's make it more simple for viewers, is that the NAV could be fluctuating more. So be prepared as to what you're doing. You can't be saying I want debt fund for consistency of return, and then pick up a duration fund.
I'll come back to the debt versus equity debate just because the market is the way it is right now, Gaurav, and a lot of our viewers would be wondering, you're getting so much advice saying these are mouth-watering levels, a great time to build up your equity portfolio. At the same time, as you mentioned, concerns of immediate money requirement. Let's shorten the duration. Let's not talk about a 7-year investment horizon, but someone who's willing to be patient for 2 to 3 years. Should that portfolio be more geared towards debt right now, or should that portfolio have a higher equity component?
Surety, as a financial planner, the external conditions has no relevance for me. So for me, if it's 2 to 3 years, it has to be a debt instrument. Now, which one do you pick up based on liquidity, tax, what do you want to do? But it has to be some debt instrument that has to be there. The moment it's 7 to 9 years, it has to be equity irrespective of circumstances. For interim, make a combination. And then probably, as I said earlier, that debt and equity has inverse relationship. Gold can come in because that doesn't have it. We are not discussing equity and gold right now. So look at your requirement. When would you need money? And based on that, have a portfolio which is diversified, but a portfolio which will generate optimum return, not necessarily maximum. So which means which will give you returns but less volatile. People always look at return, they don't look at risk as well. So kind of have
So 2 to 3 years, you're saying stick to debt, at least
always.
Always stick to debt,
Okay, and one more thing, how exactly does laddering work in a fixed income portfolio? I mean, how many different kinds of maturities do you actually need to have?
Okay.
Or is it like dependent on your goals?
Ideally, it should be. Because otherwise, imagine a situation whereby I pick up a national savings certificate and I keep investing, and now we have 5-year national savings certificate in 10 years. And I keep investing every month, and after 5 years, I'll have maturity coming in. But if I really don't have a regular income requirement after 5 years, when that money starts coming in, either I'm going to invest again or I'm going to search for new instruments, I could have tax implications. So laddering works well if you know you're going to be retiring after 5 years. Or laddering works well if you're going to go on sabbatical, or leverage works well if you're saying I want to be on my own, but there's some regular income requirement as far as laddering is concerned. Otherwise, you can do that, but then look at a situation where we're saying whenever I need money, I need to have liquidity and not necessarily just blindly doing laddering.
All right, well, that sounds really good, Gaurav. Thanks very much for joining in this afternoon and explaining not just the concept of debt funds, but also of tax-free bonds.
And all the best for your sabbatical.
Thank you so much.
Thanks so much for that. Let's take a very quick break on that note. Still ahead, it'll be time for our tip of the week. Stay tuned.